Good evening to all the participants. Today's webinar by Morningstar is very unique in content and context. Managed portfolio is the topic for today's discussion. Before getting into the background of keynote speaker, I would like to present the background of the company Morningstar. Morningstar is a household name for mutual fund investors as they are globally trusted, and they provide key data on staggering 620,000 investment products backed by about 8,500 employees spread across 29 countries with asset under management of over 229 billion USD. Morningstar is present in India for the last 10 years. They launched the managed portfolio in April 2019. The core capability of Morningstar is in asset allocation, manager selection, and portfolio construction. They have 4 unique strategies under managed portfolio to suit for different risk profiles of investors. To present the strategy, we are joined by Mr. Dhaval Kapadia, who is the Director of Managed Portfolio. He brings in 23 years of rich experience in investing in equity, fixed income, and international investing. Prior to joining Morningstar, he worked for Axis Bank in the wealth management arm of Axis. By education, he is a Bachelor of Commerce, and he is an MBA in Finance and CFA charterholder. Now I hand over the stage to Mr. Dhaval, and it will be followed by a Q&A session. So over to you, Mr. Dhaval.
Thank you, Mr. Sivaram. Thanks for the kind introduction, and good evening to all of you. Hope all of you are keeping well at this point of time. Like Mr. Sivaram said, today we'll be talking a little bit about a single asset versus multi-asset strategies, and I'm sure most of you as investors are watching the markets, hitting all-time highs every other day practically. I think today probably we closed at another sort of high in that sense. And, people are wondering that, as investors, many of you must be wondering, what should you do at this point of time? Should you sort of stay invested? Should you book profits? And if at all you book profits, where should you sort of invest that money? Should that go into debt, international equities, or gold? Or should it go into, multi-asset kind of strategies? So today we'll talk a little bit about, like I said, the risk and reward of investing in sort of single assets, vis-a-vis multi-asset strategies, and essentially how some of these can help, you as investors achieve your financial goals. So I'm just sharing my screen at the moment. Just give me a. So, I think Mr. Sivaram has already given a brief introduction to Morningstar. Just one thing that I'd like to add to that is that, our mission as a company has always been to empower investor success, right? In other words, create great financial products that help investors achieve their financial goals. So that's been, the mission of the company. I think some of the other items he's sort of spoken of. So I'll quickly sort of move ahead. Within Morningstar, there is a group called as the Investment Management Group. Now, me and my team out here in India are part of this group. And this group is responsible for providing investment advisory and portfolio management solutions to end investors. And typically we, across most countries, we do partner with advisors or with wealth managers to sort of, offer these solutions to their investors as well in that sense. And in terms of, how this group is sort of constructed or how this team is sort of spread across the world. So essentially we are based out of 3 geographies, so which includes the Americas, which includes Canada and the US, obviously, EMEA, and Asia Pacific. And sort of the way the group operates is that within each of these regions there is a hub or a center of excellence that's identified. So in other words, all the countries within that particular region. So for instance, within Asia Pacific, the hub is Sydney in Australia, where we have a large investment team. And all the countries or all the teams within that region work closely with the hub. In this case, we work closely with our Australian investment team to build solutions for the local market. So we have obviously a local team, which I'll talk of later on, and we leverage, that's how we leverage our global resources, so to say. So overall, we have about 90 plus investment professionals, across these locations and regions as such, and we manage and advise about, 250 odd billion dollars worth of assets. Just talking a little bit about, our investment philosophy, and I'm sure, many of you as investors into portfolio management services or other products would be interacting with a lot of, investment managers or fund managers and so on and so forth, right? I mean, and everybody will talk of the investment process that they have, how they select securities, stocks, or funds, and so on, right? We believe the bedrock of an investment firm is the investment philosophy that they follow, right? In terms of, what is it that guides their thinking and their decision making. So in our case, we've identified a set of 7 key investment principles which drive, our thinking on the investment management side, our decision making as well, right? So just quickly talking about these principles, and again, these principles are sort of, principles that we've observed very successful investors follow over, the last several decades, the likes of, Warren Buffett, Peter Lynch, and many other such investors who've gained success over the last so many decades as such. The first principle is that we put investors first, right? And we believe that firms that put investors first win over the long term because, their investors would tend to win over the long term. So, any solution, any research, any product that we are creating, we're thinking of, how it will benefit the investor first, right? The second principle is that we are independent minded. And what this essentially means is that, we believe that if you have to generate performance that's superior to the markets, you have to think differently, right? If you think with the markets, if you buy when everyone else is buying and sell when the rest of the market is selling, your performance will be entirely, market linked in that sense, right? So if you have to generate superior performance, we believe you have to think differently. And, we are not afraid of at times even being contrarian investors or having a contrarian view, as long as it's backed by, our research as such. Next is we are long-term investors. And what this means is that, typically our views or our investment horizons tends to be, beyond 5 years generally. And, our views across asset classes will be typically for, 3, 5, 7, 10-year kind of periods. And, the reason a long-term investment horizon is essentially so that you can ride through different market cycles and also identify opportunities at various points in the cycle, right? So if somebody was a short-term investor, last year in March, April, when the market saw a sharp correction, they would be more concerned about, how would they gain their liquidity and how would they protect their capital, rather than looking out for opportunities. Whereas in our case, we're thinking at such points of time, where do the opportunities lie? Next is we are valuation-driven investors. So what this means is that we believe that the price that you pay for the value of a security or an asset class, right, is a key driver of the performance that you will generate over the long term. So in other words, valuations we believe is a very important component of the investment process or the decisions that one would make, and therefore it forms a core part of our investment process and decision making as such. Next is we take a fundamental approach. So what this means is that we spend more time and we believe more in fundamental research, so understanding cash flow drivers of the asset classes that we own, what drives the profits and so on and so forth, and we don't really delve too much into technical analysis as such. Next is we strive to minimize costs. So we clearly believe that high costs impact investor wealth, and they impact compounding, that should benefit the investor. So therefore, our role is to try and, or one of our goals is to try and minimize costs across the investment products or solutions that we offer, right? And finally, we build portfolios holistically, right? So what this means is that we believe that portfolio construction is not just about adding more securities or more asset classes in the portfolio. Rather, it's about adding asset classes and securities that will react differently in different economic scenarios, right? So that's what we strive to do, and we'll talk about some of these further as we sort of go ahead. Talking a little bit about our core capabilities or the areas where Morningstar Investment Management is focused on, and Mr. Sivaram touched upon it earlier as well. asset allocation is one area, and why asset allocation? Why do we think it's so important, right? Research over several decades has shown that the key driver of portfolio performance is asset allocation, right? In other words, the decision on how much to invest in each asset class is the key driver of performance that you will generate over a period of time. So, how much do you invest in equity, debt, international equity, gold, etc.? So those are the key drivers of portfolio performance rather than market timing or security selection. And this has been shown by various studies. So therefore, we spend a lot of time in building asset allocation models which are more forward-looking in nature, which will help investors achieve their future goals as such. Next is manager selection. So what this essentially means is again research on mutual funds. So again, out here, Morningstar has been involved in providing research and ratings on mutual funds. And again, a lot of these ratings are also forward-looking ratings or forward-looking convictions. So that's an area we've tried to build capabilities on and providing forward-looking views on funds, right? As an investor, one is you see the past track record of a fund, right? But what's of more interest to anybody, I would say, is that how is the fund expected to perform in the future, right? So does it have the capabilities or capacity to do well and help me achieve my goals in the future as such? So that's where our fund research team spends time on. And finally, we combine the asset allocation and our fund research to construct portfolios for clients, diversified portfolios with sort of various asset classes as such, right? Now, jumping into the core part of the discussion as such. So, obviously, just talking a little bit about what's been happening over the last 12 to 18 months, I'm sure all of you are tracking markets as such. But just to give a slightly broader picture, here we're looking at about 5 sort of markets or asset classes, if I can call them as. One is obviously Indian equities, which is the red line that you see across this graph, which is the BSE 500. You have the S&P 500, which is the US broad market index as such, which is the blue line again that you see along with just above the red line out here. The third is global markets as a whole, which is the MSCI All Country World Index, which represents global equity markets. So these are 3 equity indexes, and then you have Indian fixed income and gold, right? So these are the 5 sort of asset classes that we are looking at, and we're looking at how they've performed from early 2020 till a more recent period. So obviously, as we know, and all of these have been rebased to 100. So if you had invested 100 rupee in all of these assets or any of these asset classes, how would they have performed over this time period, right? And clearly, as we know, markets witnessed a big dip in March, April of last year, and not only India, but as you can see, US equity markets as well as other global equity markets. So, witnessed, sharp corrections at that point of time to the tune of about, a 25 to 35% or so. At the same time, gold was relatively steady. So in fact, the green line that you see on top, gold did pretty well during the period that the markets were a bit subdued, and it generated fairly I would say fairly strong performance during that period. Whereas fixed income, which is represented by the gray line in between, was relatively steady, so to say. Obviously, since then we've seen a sharp bounce back in markets, which has been driven by one is obviously vaccine availability, a stronger than expected economic rebound, and of course central bank action, the liquidity support that central banks have provided. Some of it has come to financial markets, and this is what has been sort of driving the rally across various asset classes, right? But the question is what next? What should investors do? Markets not only in India but globally as well. Particularly the US and several other markets have been hitting sort of fresh highs. They've sort of had a strong rally over the last 12, 18 months, as we saw in the previous slide, right? And what we are observing at least is, and what a lot of global experts are saying is to exercise caution to a certain extent. I mean, so people are thinking that One is obviously inflation seems to be a big risk out there, and concerns around, whether central banks might start sort of, rolling back some of the liquidity support that they've been providing to markets. So that's one concern. Obviously, there are concerns around, the Delta variant and so on and so forth. I mean, I'm sure, all of you are probably reading a lot about it anyways, but, that's a concern that's sort of looming over markets. We see, sort of the virus keeps coming back, in one country or the other as such, or one region or the other. So that continues to be an area of concern, and how it could impact economic performance as such. So therefore, at least globally, a lot of experts are thinking that, markets have had a strong run up at this point of time. And, there is a certain sort of degree of caution that is being sort of spoken about at this point of time as such, right? And just, changing gears a bit, we've spoken about what's happened in recent times over the last 12, 18 months, across different markets, but just trying to, look at a slightly broader picture and try and look at how various asset classes have performed, over longer periods of time, right? And, many investors tend to invest, in asset classes that they are comfortable with, right? I mean, and probably at times may forget, the risk associated, or the risk and reward, balance between, various asset classes as such, right? So we'll try and quickly look at how, various asset classes have performed over sort of various periods of time, right? And just to sort of, the way we are looking at this is in the form of, real returns. So what this means essentially is that how have each of these asset classes performed in terms of, inflation adjusted returns, right? Because at the end of the day, inflation eats away at one's wealth. So therefore, we believe it's important to look at returns after inflation, or in other words, real returns, so that they can be comparable across time periods. So as we can see out here, we've compared three sort of major asset classes that a lot of Indian investors look at. One is obviously fixed income, which is at the bottom. It has beaten inflation, but it has generated a real return of about 2%. And here we're talking about a 25-year time frame starting from 1996 to July 2021. And gold has generated a real return, an annualized real return of about close to 4% over this 25-year period. So it's beaten inflation, which is what it is expected to do, over longer periods of time. And it has also done better than fixed income as such. And if you look at Indian equities, it has generated much better real returns. So after inflation, it's generated a real return of about 7.5% on an annualized basis over 25 years. So, clearly amongst these asset classes, Indian equities have been the best performing asset class, so to say, right? But this is only a part of the story, right? Like they say, picture abhi baki hai. So then there is more to come, after this. So one part of when you look at asset classes is the performance or the returns, right? But the flip side is the risk as well, right? So let's look at, some of those risk factors or risk elements for each of the asset classes as such. So to begin with, here we are looking at Indian equities. And when we talk of risk, to our minds, a key measure of risk is drawdown, right? So what is drawdown? Drawdown is nothing but the maximum fall in the value of an investment. So when I say maximum, is from the peak value of the investment to the lowest point of that investment. What was that fall in that value, right? So that is the maximum drawdown, or that is a drawdown, from the peak level to the lowest point is referred to as the maximum drawdown for an investment per se, right? So for instance, if somebody had invested in early 2008, right? I mean, just before the global financial crisis sort of hit the markets as such, right? When the markets were at a peak, right? In Indian equities and in some other places as well globally. And so that was like a peak level. And what was the bottom level is something that you would have witnessed maybe later in that year, right? So that becomes the drawdown. So from the peak to the trough, what was that fall in the value of the investment is the drawdown. So if I were to look at Indian equities over the last about 20 odd years, there have been, and here we've marked out periods where the drawdowns have been greater than 20%, right? So there have been 4 such periods when the drawdowns have exceeded 20%, right? And so one is in the initial period, which was, which is there on this chart, which is 2000, 2001 kind of a period, when, that was a time when you had the tech IT, bubble sort of bust in that sense, and you had markets in India as well as globally correct significantly. So that time you saw a drawdown in Indian equities of about 58% or so, which is quite significant. Then, much later in 2008, 2009, when the global financial crisis hit, again, Indian equities corrected by about 60% or so. And more recently, obviously, we know last year as well in March, April or so, markets corrected by about 37% or so. So these are periods when markets in India have witnessed significant drawdowns. Obviously, we had similar trends in other markets. We'll look at that as we go ahead as well. Another important aspect about the risk or the drawdowns is the recovery period, right? So one is we are talking of to what extent have markets corrected during this period, but also about how long did it take for an investor to recover their initial investment, right? So for instance, like I was giving the example earlier of somebody investing in early 2008, they saw a correction of about 63, 64% by October, November of 2008. So, but towards the end of the year, the value of that investment came down by about 60 odd percent, right? And how long did it take them to recover that initial investment, right? So it took them about 86 months. So that is about 7 years to actually breach the investment that was made in early 2008. So the value of the investment that was made in early 2008, because that's when the markets actually, crossed the previous peak, was in about 2013, 14 or so. So it took about 86 months to recover that initial investment. And imagine if somebody had a goal that they wanted to achieve, they needed money after 5-6 years when they invested in 2008, thinking that 5-6 years is a decent horizon. They may not have recovered their capital as well, right? So this is a flip side of investing in a single asset class such as equities. The returns can be strong, as we saw in the previous slide, but the downside is something that one has to be mindful of as well. Just sort of moving on, and if you were to compare, how different asset classes have moved, at different points of time. So again, just extending the previous example that we were taking of Indian equities and drawdowns. Here we are comparing the drawdowns for Indian equities versus gold, which is marked out in yellow, fixed income, which is green, and international equities, right? So that's one that we've added out here, which is international equities within this range as such. And all of them, like I said, compared to how Indian equities have performed when markets have seen a drawdown, right? So again, the 3 or 4 periods that we were talking of earlier, as you can see out here is that generally we have seen that drawdowns from fixed income and gold have been much lesser, which is what one would expect during periods when there is significant market volatility. We spoke of some of those periods on the previous slide. When there is a lot of market volatility or economic uncertainty, gold or fixed income tend to do relatively better. So they've seen lesser falls, or their drawdowns have been lesser. And not only that, but even international equities across these time periods, we've seen that the drawdowns have been much lesser to that extent. So in other words, some of these other asset classes have fallen lesser when during these periods of significant market volatility or sort of economic uncertainty, so to say. So why are we talking of drawdowns? Why are we focusing so much on the downside, right? And the reason for that is that there are 2 different stories. If you 100 rupee going up to by 20% and 100 rupee going down by 20%. So if you invest 100 rupee and if there is a fall in the value of that investment, if it comes down to say, if there is a correction of 20%, how much would you need to recover your investment, right? That percentage or that proportion tends to be much higher, right? So in other words, the more you fall, right, you need much more to recover back your original investment. So for instance, if you were to fall by, if your investment were to fall by 20%, you need a 25% return from 80 rupees to go back to 100, right? And if the investment were to fall by, say, 50, 60%, which is what happened in 2008, 2009, you need, if it fell by 60%, you need a 150% return to go back to your original, just to go back to your capital, in other words. So 100 rupee investment has fallen by 60%, has come down to 40 rupees. You need a 150% return to go back to your original 100 rupees, right? And that's quite a lot, right? So in other words, that's the reason we saw that, when the fall was very sharp, the recovery period was long, because it took, there was a bounce back in the markets for a certain period of time, but you could recover your capital only after about 6 to 7 years, which is a fairly long period, because you needed about a 150% return to go back to your original investment or the capital that you invested as such. So therefore we think it's important to keep in mind that how do you limit drawdowns in your investments as well, right? So it's not just, or how do you limit risk or reduce risk in your investments as well, and not just focus on the upside or on the positive returns as such, right? So what's the way to sort of try and optimize returns, and how do you, and like I said, how do you reduce risk in your investments, and how do you optimize the return that you're generating for the risk that you're taking, right? So one way, at least to our minds, to do it is through multi-asset investing in that sense. And what does that essentially mean? And probably some of you are sort of following it, but just to try and broaden that thought process or thinking in that sense. So multi-asset investing essentially means combining different asset classes with varying economic drivers. So it just doesn't mean adding, like I said, multiple funds. So it's not about adding, instead of holding 20 stocks, I buy 30 Indian stocks or 40 Indian stocks or 50 Indian stocks. That is actually not multi-asset investing. If the market in India were to correct significantly, you'll see, most of these stocks tend to also correct at a similar point of time. So in other words, you need multi-asset investing, like I said, is investing in assets which will react differently to different economic drivers, right? And what does this actually mean is that if I were to take a few examples from what is put out here, Indian equities, obviously, I'm sure all of us are familiar with it. They provide exposure to Indian economic growth drivers, right? If the economy does well, Indian corporates do well, Indian equities would tend to do well, right? But what about other asset classes such as global equities or gold, right? So gold tends to provide a hedge against inflation and a hedge against the currency, and it also does provide a hedge against economic uncertainty. We saw some of it in the previous slides where gold has performed better when markets corrected even last year or previously as well, right? So it tends to act as an inflation hedge. Fixed income, again, we know this tends to provide a relatively secure cash flow stream, so will tend to be that's the benefit that it will add to the portfolio. It acts like a safety net in the portfolio as well, right? And global equities, I think they provide significant benefits. One is it provides a larger opportunity set, right? So in other words, you are able to invest in securities or stocks that have different economic drivers. So obviously, stocks that are listed in the US, we know those names, right? The Facebooks, the Amazons, the Apples, not just those, but many more companies will have different drivers in terms of how their performance could be driven. In other words, say if the Indian economy doesn't do well, which we saw in the past, even before the pandemic, and markets out here, if they don't do well, these stocks, global stock may not be completely impacted by that, right? Because they would be driven by how the local economy out there or how other economies are performing, rather than a single economy per se. And again, they provide foreign currency exposure as well. So those are some of the sort of benefits of sort of combining different asset classes. And we spoke about international equities a bit, right? So why do you need to invest in international equities in India? Traditionally, most investors have been focusing their investments in the local market. People like they say, the home bias has been pretty strong, right, in India as such. But if you look at how much does India comprise of global markets as such, right? It's less than 2 or 3%. Here we've taken the share of a global market index. which is the All Country World Index, the MSCI All Country World Index, and US obviously is the biggest component of that. Even other countries such as Japan, China, or other European countries comprise a significant portion of that. And India is still, obviously, it's a growing market, but still it's a small component of the global market. So, there are lots of opportunities out there, is the other message. And even if you look at it in terms of the global economy as such, again, India comprises just about 3% of the global economy. A large chunk obviously coming in from the US, about 25%, Japan about 6% and obviously China has grown pretty well. So about 17% of the global economy is coming from China as such. So in other words, whether it's, if you look at the economy or you look at the markets as such, globally, the opportunities are quite significant and quite vast in that sense, as compared to or to complement India is what I would sort of say. Another reason why we think diversification is important, and on this slide, what we've done is we've put out performances of various asset classes or various markets across different time periods, right? So starting from, and here we're talking of calendar year-wise returns, and I don't want you, I know this is a busy slide with a lot of numbers, but I don't want you to focus on the numbers necessarily. What we've done is, on a calendar year-wise basis, we put down the performance of each asset class, right? And for each calendar year, the asset class that has performed the best is marked in a dark green shade, and the asset class that has performed the worst is marked in a dark pink or a red kind of a shade, right? So, for instance, if we were talking of 2008 earlier as well. So, most global equity markets saw correction during that period. Indian equities were down by more than 50% odd. So it's marked, it was the worst performing asset class during that year. But Indian fixed income did much better than the other sort of markets. And, it generated about a 20% odd positive return, and it's marked in a dark green shade, right? So out here, similarly, we put down, performances for US equity, developed markets, European equity, Indian equity, and emerging markets as such, right? So the thing to observe out here, an important trend to observe out here is that that year on year, it's the asset class that performs the best or worst is very difficult to predict or pick in that sense. So in other words, it's very difficult to pick winners and losers on a year on year basis, right? So you see, for instance, 2008 was a poor year for Indian equities, but the next 2 years it was the best performing asset class, right? So and then subsequently it again was, it didn't, it underperformed other asset classes in 2011 or so. So therefore, it's, this trend tends to change quite a bit, right, across different asset classes and markets. The other aspect to observe or notice is that, there are periods when Indian equities haven't done well, international markets have done fairly well, right? So for instance, if we were to look at periods such as even 2019, when Indian equities generated a 9% kind of a return, global markets such as, US or even European markets generated much better returns during that period, right? And similarly, even 2013 is another such period when Indian equities underperformed and global markets did fairly well at that point of time, right? So that's another trend to observe, that there are periods when different markets do well at different points of time, right? And therefore, in a way, it pays to be diversified. The other thing that we've included out here is a multi-asset portfolio. So if I were to combine some of these asset classes that we're seeing out here, how would their performance sort of look like, right? So, the multi-asset portfolio is the one in between. So here we've taken like a 50-50 portfolio. So 40% of that invested in Indian equity, 10% in international equity, and the remaining about 45 to 50% in debt, and about 5% in gold as such. So that's how we've constructed this multi-asset portfolio. And as you can see out here, the multi-asset portfolio hasn't been very volatile, right? So it's neither been the best performer in a particular year, nor has it been the worst performer. So in other words, the performance has been fairly consistent across the time periods, right? And towards the end, we are also showing the annualized return, or the CAGR, in other words, for each of these asset classes, as well as for the multi-asset portfolio as such. And as you can see out here, from 2008, if you were to look at the track record, obviously, several global markets have done, better than Indian markets as such. Obviously, this is the period that we picked, but it's a fairly long period, right? About, 12, 13 odd years as such. And the multi-asset portfolio has also done, fairly well, during this period as such. So in other words, I think the key message is that it sort of pays to be, diversified across multiple asset classes because of the variation in performance that you would see across time periods. So just talking quickly about, the proposition and keeping in mind what we've sort of just discussed as such as well. We've launched a set of 4 multi-asset strategies in India, and we've been offering these for the last about slightly more than 2 years in India as such. And when I say multi-asset, obviously these strategies invest across different asset classes, which include Indian equity, fixed income, international equity, and potentially gold, right? And each of these strategies is also suited for a different risk appetite and a different investment horizon, right? So for instance, if you're somebody with a horizon of say 5 to 7 years, a moderate kind of a risk appetite, there is a balanced portfolio which one can look at for that kind of a horizon. And as the investment horizon increases, obviously the allocation to equity would tend to sort of increase in the portfolios as such, and obviously along with an increase in the risk appetite as well. So, just looking at some of these portfolios a little more closely, if I were to pick the, say, the active growth portfolio out here, the donut chart or the chart that you see on the screen shows, 54% allocation to Indian equity, about a 16% allocation to international equity, and a 30% allocation to, fixed income and cash, right? So, essentially, these are what we call as a neutral or strategic allocations, right? So if each of these asset classes or markets are trading at their fair valuations, this is how the portfolio would be sort of, allocated as such, right? And but as we know, across different time periods, markets tend to be volatile. At times they're overvalued, or at times they're undervalued in that sense. So therefore, based on the attractiveness of each asset class, the allocations will be actively managed, right? So, so for the growth portfolio, for instance, domestic equity, the allocations could vary in the range of 40 to 70%, fixed income in the range of 20 to 50%, international equity in the range of 0 to 30, and gold in the range of 0 to 15. So based on our views across each of these asset classes, the actual allocations would vary from time to time, right? So for instance, at this point of time, we think Indian equities have had a fairly strong run for the last 12 to 18 months. And we think, they look a little bit overvalued. So we are sort of slightly underweight, Indian equities in our portfolio. So instead of in a growth portfolio, say an allocation of 54%, we might be slightly lower than, 54% in the actual portfolio. The actual allocation might be slightly lower than the strategic or neutral allocation out here, right? Another aspect about the portfolios is that is within each of these asset classes, there are other buckets that we invest in. So for instance, domestic equity, the allocation is split into large, mid, and small cap. International equity into 3 regions, which is US, Europe, and emerging markets. So these are the 3 broad regions that we are investing in, right? And fixed income is split into short-term, medium-term, and long-term debt, besides cash. So those are the broad asset classes that we are investing in each of these portfolios. So in a sense, the idea is to invest more in asset classes that are looking attractive from a risk and reward perspective, right? And lesser in asset classes that are not looking so attractive at a point of time, right? And the underlying allocations into these portfolios go into mutual funds, right? This could be active or passive funds, right? And potentially, we could also add ETFs into the portfolios, based on our views as such. So, and the mutual funds are invested through the direct plan route. So, essentially, direct plans, probably a lot of you might, be familiar with those as well. Direct plans, the expense ratios tend to be lower. There is no, because there is no commission component that's included in the expense ratio. So they need to be lower cost as compared to regular plans. And therefore, there's no sort of conflict of interest. So therefore, we don't earn anything from holding those mutual funds in the portfolios from the fund houses per se. So that's how the underlying portfolios are constructed and sort of managed as such. Just quickly talking about how the allocation in these portfolios will tend to move, and how the allocations are as such managed. Typically, when markets are sort of have not generated very strong performance, or markets have sort of disappointed, like say March, April of last year, when we saw a significant correction in the markets and valuations are looking reasonable, is when we will tend to reduce our holdings in debt and cash and add allocations into equities in the portfolios, and vice versa. When markets have generated strong gains and valuations are looking stretched, we refer to that as a more of a high risk market environment, is when we will tend to reduce our allocation to equities and add allocations into debt or cash in the portfolio. So that's how typically the allocations would tend to get managed in these sort of portfolios as such. So in a sense, these are like we said, multi-asset strategies, and the asset allocation is actively managed based on our sort of valuation driven views as such. I know we've already passed about 40 minutes or so. So maybe I'll run through some of these slides quickly, and maybe we can take up some of the slides in Q&A as well. So I'll just skip through a couple of slides on the asset allocation calls per se. Or do you think, Mr. Sivaram, should we cover these at this point, or can we cover them later on?
Sir, it is a brutally honest presentation, and there is no art stop, sir. And
okay.
You can cover as much as you want.
Sure. Fair enough. So I'll just quickly talk about a couple of these slides, and then we'll try and summarize the entire thing. So just talking a little bit about how the allocations have moved in the various portfolios, and here we take the example of the sort of the aggressive portfolio, and we are looking at how the Indian equity allocation has moved within this portfolio over the last about couple of years or so, since we launched these portfolios in April 2019. And the way sort of we are depicting them and I'll just quickly talk through this chart, is what we've done is we have split the Indian equity allocation into three buckets, which I mentioned earlier, which is large, mid, and small cap. So here we are sort of depicting, one is what are our normal allocations, right, or our neutral or strategic allocations, which is indicated by the dotted lines, which are if markets or large, mid, and small caps are trading at their fair valuations, how much would we allocate to each of these buckets within the aggressive portfolio, right? Now, if I look at the large cap, is indicated by the orange dotted line, the neutral allocation. Small cap is indicated by the gray dotted line that you see out here, and mid cap is the yellow dotted line, right? So this is how the neutral allocations look like. So for large caps, you need to look at the right hand side, y-axis as such. So for large caps, the neutral allocation stands at about 48%. For small and mid caps, it's at about 7% and 13%. So small and mid caps are represented on the left hand side, y-axis that I'm pointing out to. So like I said, small cap, the neutral is at 7%, and for mid caps, it's at about 13%, right? So that's how the neutral allocations look like. Now, the bold lines indicate how these allocations have actually moved in real time across over the last about 2.5 years or so. So, when we launched the portfolios, we felt that Indian equities were looking a bit, the valuations were looking a bit stretched. So we were underweight Indian equities to begin with. So all the bold lines, so the orange bold line indicates the actual large cap allocation. The yellow bold line is the actual mid cap allocation. And the green bold line indicates the actual small cap allocation in the aggressive portfolio. So each of these, as you can see, are below their neutral allocations, which indicate that we were underweight Indian equities at that point. Come March and April 2020, we felt that Indian markets, with the sharp correction that we saw in the markets, valuations were looking attractive, and we added, about 12% into Indian equities. So therefore, you see the allocations jump across. The bigger jump is in large cap, but we added to small and mid caps as well, at that point of time. And in more recent times, we've trimmed a bit of exposure. We've sort of rebalanced a bit, and because the markets have had a strong rally, and we feel that valuations are a little bit in the expensive zone, although not significantly expensive, but a bit expensive, and therefore we've trimmed some allocations to Indian equities in the portfolio. So therefore you see the allocation sort of coming down in recent times, and these are somewhere around the current allocation. So large cap is in and around the neutral level, slightly below the 48 mark. Small cap is about 7.5% kind of allocation at the current juncture, and mid caps are slightly below the neutral allocation level as such at this point of time. In the interest of time, I'll just skip through maybe the next couple of slides, and we can probably talk through them in the Q&A. But just to sort of quickly summarize, on the proposition as such, one is, being a multi-asset strategy, we think it's a sort of end-to-end kind of a solution for investors. So because we are investing across different asset classes, which typically investors would need to look at when they're planning for their long-term goals. We are also looking at, fund selection. So that's what, the fund research or the fund selection part is also sort of covered in these strategies. Obviously, constructing the portfolios, managing and reviewing them is something that we do as part of the solution as well. And there are options that suit different investment needs, which we saw, 4 strategies suited to different, investment horizons and different risk appetites per se. And also, obviously, there is a fair bit of transparency in terms of the communication on portfolio updates, the changes that we make to the portfolios as well. The other part is that obviously you are able to also receive or benefit from both global as well as local portfolio management expertise, right? Because like I said, a lot of our views on global asset classes come through our global research teams. We work closely with our Australian investment team. So the investment process that we follow in these strategies is the same as the ones that we follow in other markets as well when we are running multi-asset strategies. Obviously, it is backed by local research as well. And the fund research is locally driven. We have a separate fund research team in India, which sort of builds views on different mutual funds and helps us pick funds for the portfolios. And finally, we believe that the costs are more effective out here because we are investing into the direct share class of mutual funds, so the costs tend to be lower. And the investment management fees are also relatively sort of more competitive in that sense. And finally, to sort of summarize the entire sort of presentation in terms of what we've discussed, over the last about 45 odd minutes or so. One is, single asset investing can generate wealth. I mean, we saw, how Indian equities have performed over a longer period of time. But, the risk obviously can be higher, and it could be at the cost of sort of, higher risk or, uncertainty as well. The other thing that we saw as well in the slides and that we discussed was that international equities can provide exposure to varying growth drivers, and they can act as an effective sort of diversifier to the overall portfolio. And next is that multi-asset strategies, at least in our view, help in generating better risk-adjusted returns. So keeping in mind the risk as well, so the balance between risk and reward, so to say, is something that can come through multi-asset strategies. And eventually, Morningstar has been helping investors achieve their financial goals over the last several years as such. So, that's something that, we bring to the table as well. So I'll sort of stop here and, we can sort of open the floor for questions.
And in fact, investors must have taken aback by one drawdown slide which you have shown in 2008, where the market fell by 63%. It took 86 months to recover. That one slide must have given a good lesson how important the asset allocation is to for the investors.
Absolutely.
And now I'll get into the questions.
Sure.
Why a mutual fund portfolio should be given to a professional? Already it is handled by a fund manager who is a professional. Why the second layer is required? Is the first question is coming.
Absolutely. It's if I were to give a counter kind of an example or something out of the normal is like to pick a very great cricket team, right? You may have excellent players, you may have people who are doing very well in their respective areas. But you need a coach, you need somebody to pick an excellent cricket team as well, right? To build a strong team. So it's not about picking just the best batsmen, but it's picking a team which is a good mix of batsmen, bowlers, and all-rounders, and so on and so forth, right? So similarly, I think it's not just about picking funds, it's about picking the right kind of funds that fit into the portfolio, right? So I think that's important when it comes to picking mutual funds. And just talking of a few numbers out there is that if you look at even the last few years, I mean the last 3 to 5 years, we were just looking at this data the other day. The range of returns across each category of mutual funds is pretty wide, right? So when I say wide, say across multi-cap, large cap, or small cap, the range is about, varies anywhere from about 5 to 6%. So for instance, in large cap funds, over the last 5 years, the range of returns has varied from 8% to 14%. So what that means is the worst performing fund has generated a return of about 8 odd percent. The best performing fund has generated a return of about 14 odd percent, right? I mean, similarly, if you look at small caps, the range is even wider. So my point is that it's picking funds also requires a fair bit of research and inputs when it comes to identifying which funds to pick for your portfolios. And from our point of view, we are not just looking at the historical track record. What we also tend to look at, and that's a core part of our research and the ratings that our analysts provide as well, is building a view on a forward-looking view on a fund, right? So in terms of how is a fund expected to perform in the future, right? And how do you really analyze that, or how do you really build a view on that, right? So that's an area that we spend time on in terms of talking to managers, understanding their styles, which style would perform at different points of time in different market scenarios, and then try and pick funds. So I think there is much more to picking funds than just looking at past performance or historical track record, and that's what we try and do, and that's where we try and sort of come in with our thinking and our process.
Oh, thank you. Thank you very much. The second question, it was an eye-opener that in 2009, even fixed income gave a return of minus 6.3. Okay, and it was a real eye-opener. And people are thinking fixed income cannot go negative. And now repo and reverse repo are almost equal. And the returns, excepting the credit risk funds, where it is varying between 4 to 5%. What is the outlook in the active portfolio, where you are even going to allocate 70% in the fixed income? What is your outlook for the fixed income for the next 5 to 7 years?
That's a pretty long horizon to look at, to build a view on fixed income. Fixed income markets tend to be pretty dynamic. But, the way we are seeing it is that one is obviously interest rates. We've seen over the last couple of years have come down. Central banks, I mean, not only in India, globally as well, have cut interest rates by a fair margin to support the economy since the onset of the pandemic. Obviously, the Reserve Bank of India has done a similar thing. But when we look at the yields, where they are sort of trading and where they are placed in that sense, at least we feel that the shorter end of the curve doesn't look as attractive, right? So what that means is that the spreads that you're earning versus the repo rate, or versus other very short-term interest rates on the 1 to 3 year paper, the yields that you're earning are not looking as attractive, right? And on the other hand, we think the medium to long duration of the curve still looks attractive. But that is sort of an interest rate kind of a view. But I would think that a bigger role for fixed income in portfolios is to act as a safety net, right? So it's not just about generating significant returns. In fact, if you looked at, say, last year when the markets corrected significantly, fixed income was relatively steady, which we saw in the first slide as well, right? I mean, fixed income was, so in a way, fixed income also plays the role of providing a cushion to the portfolio. So, it's twofold. So one is, trying to generate, better risk-adjusted returns and also provide a cushion. So, for instance, if another asset class is looking overvalued, we would probably move some money from that asset class. Say if it's equities or any part of other markets which is looking overvalued, we might move some money from there into fixed income or cash, which would act as a safety net in case there is a sharp correction or drawdown in the other part of the portfolio as such.
The third question is on what parameters you select the asset allocation for different asset classes in different market cycles?
Yeah, I think that's a very interesting question, and that can take up another complete webinar as well. But if I were to sort of just try and show you in summary in terms of how we do that, so I'll just, in fact, I have a slide around that. So I'll just pull up that slide if you allow me to. So, when we talk of, the decision on which asset classes to invest in and which asset class is looking more attractive, like I said, the goal of some of these strategies is to invest into asset classes that are looking attractive from a risk and reward perspective, right? So when I say attractive is that, and also from a forward-looking perspective. So sitting today, which asset classes are looking more attractive, over the next, where I can put in money and invest in over the next, 3, 5, 7 years or so. So the way we go about doing it is that we use about 4 pillars, or we would, we can call them as 4, key drivers or parameters of that decision. So first is we look at the absolute valuation of the asset class, right, relative to its history. So for instance, if I'm looking at Indian equities, I will look at that today, what is the kind of valuation or what is the price that I'm paying for, Indian equities, say it's large, mid or small cap, any of these bucket, and how does that valuation compare relative to its own history? So is it looking cheap or is it looking expensive, as compared to its own history? So that is one parameter. The second is the relative valuation. So large caps versus mid cap versus small cap within India. Then Indian equities versus international equities. Say, we spoke of US, Europe, and Asia Pacific. So, these are the 3 markets that we look at. So, Indian equities versus each of these 3 markets on a relative basis for similar asset classes, how do they stack up in terms of risk and reward and in terms of valuation, right? So that's the second parameter that we look at. The third is contrarian indicators, right? So which we think is important as well, that what is the investor sentiment towards that asset class? Is everybody chasing that asset class or are people, selling down that asset class at this point of time? If I were to give an example, which is very recent and probably people have been reading about it, is Chinese equities, so to say, right? So we've seen people selling down Chinese equities because of, regulatory concerns, because of, what the government out there has been doing, to sort of, for some of these big companies out there, the Alibabas and so on and so forth. So there is a lot of pessimism towards that particular asset class. So typically we see that when there is a lot of pessimism, there is a chance that that asset class is looking attractive or it may be, valued attractively. So those are some of the things that we try and look at, that what is the kind of optimism or pessimism in terms of fund flows or investor interest, or how has that asset class moved in more recent times as such. And finally, we look at fundamental risk. So what is the downside risk to that asset class? So again, if I were to take the example of Chinese equities, right, it's not as if it's without risk, right? I mean, we've seen significant regulatory changes come in, the government talking up quite a lot, and there is so what is the kind of fundamental risk that's involved in that particular asset class? And then so we assess all the asset classes on these kind of parameters and then take a decision or a view, and we rank these asset classes in terms of which one is looking relatively more attractive from a risk and reward perspective, and we invest more on those asset classes, and we go underweight on the ones that are not looking as attractive as well.
You spoke exhaustively on asset allocation. Asset allocation is for alpha generation or risk mitigation is what someone wants to know.
I would think it's twofold, right? And that's what I was trying to point out earlier, that risk mitigation can be a part of alpha generation as well, right? In the sense that if I am able to reduce my risk, right? If, like we said earlier, if my drawdowns are lesser, if I fall less when the markets are falling, the chances of me generating a positive return, because as an investor, you're looking at returns above 100 from your capital. You're not looking at returns from the low point, when the markets have corrected by 30, 40, 50%, and your value is at 50 rupees, you're not looking at returns from 50, you're looking at returns from your initial investment. So if I fall lesser, the chances of me generating a better return on your initial capital tends to improve, right? So I would think they go hand in hand, and I don't think one should look at them separately. And I definitely think that, multi-asset strategies have the potential to generate, alpha by also mitigating or reducing risk.
And a keen watcher of your presentation, Mr. Dhaval, wants to know, in active aggressive portfolio, your international equity allocation is 0%. And in 10 years view, that does it mean that your gung-ho about Indian equities is what you can infer?
No, that is actually the active aggressive class portfolio that you're referring to.
Yes.
And I'll just go back to that slide for a moment so that we can just sort of quickly have a look at those allocations. And you're right. So the first three portfolios, from balanced to active aggressive, are diversified across domestic and international equity. The fourth portfolio, which is the aggressive plus portfolio, we constructed that keeping in mind that in India, the home bias has been pretty strong, right? A lot of investors want to invest only in India. So therefore, we thought we'll construct a portfolio which is an India-focused portfolio only, so that gives a good comparison versus the other portfolios as well, right? If I were to compare from a risk-reward perspective, whether the other portfolios versus the aggressive plus, it gives a good comparison. So it's not because obviously we think Indian equities will do well over a period of time, but we think it's important to diversify as well, right? So therefore, and if you look at, on the contrary, if you see that, and if you observe, the active aggressive plus portfolio has actually got a higher equity allocation as compared to the aggressive plus. So it's like a 90-10 portfolio versus the 80-20 in the aggressive plus, right? So like I said, it's primarily the fourth portfolio was a domestic only portfolio, only keeping in mind that Indian investors at times prefer only a home kind of allocation, or they have a home bias. So keeping that in mind, we constructed this portfolio.
We'll take last two questions. And in fact, in 2008, this multi-asset portfolio fell 13.3% against market fell Indian equities at 57.6. That itself is a clear vindication that asset allocation definitely works. And last two questions I'll take, sir. And
sure.
Is STP allowed in your portfolio?
Yeah, absolutely. So what we've done is that, because obviously for PMSs, as we all know, the minimum ticket is 50 lakhs, right? So therefore, that becomes the minimum ticket to start the portfolio. So what we've done is keeping in mind, again, a lot of investors want to invest in a staggered manner rather than at a one go, particularly when markets have done so well. So we've created a liquid portfolio, which essentially comprises of a liquid and an overnight fund. And through this portfolio, we can do an STP into the main portfolio. Say, for instance, if based on your risk appetite and your horizon, say an aggressive portfolio has been selected for you, and you want to stagger the investment into the aggressive portfolio, say over the next couple of months. So your initial investment can be made into, say, the liquid portfolio, and from there we can do an STP into the aggressive portfolio, say over the next month or two, as you like. So that option is very much sort of available with us.
And the last question: how often you look back and churn your portfolio? Someone wants to know.
Yeah, so that's again a very good question, in the sense that like I said earlier, one is there are two things to keep in mind, that the views that we build on these asset classes tend to be long-term views, right? I mean, when I say long-term, these are convictions or views that we are building over the next, how these asset classes are expected to perform over the next, 3, 5, 7 years or so, right? But having said that, we also realize that markets can be quite dynamic. So we tend to review our allocations on a month-on-month basis. But the idea is not to make changes, because the views are based on long-term expectations. We don't expect too many changes in the portfolios, and which we saw in the equity allocation graph as well. We, despite the markets, obviously the markets have been very volatile over the last 12 to 18 months. So we've made a few changes, but they are not too many as such. So we review the portfolios on a month-on-month basis, but we don't tend to make changes that sort of frequently. Typically, changes will be made only if there are significant moves in the market. So typically we see that if the markets move up or down by 15-20% is when the allocations would tend to change as such, or that's when we will tend to make changes in the portfolios. Otherwise, for smaller moves in the market, they will tend to generally remain steady state as such.
Okay. Is there any closing remark? And in fact, it was really fascinating. I liked the way it went and the way you have explained how important the asset allocation is. Really fascinating. Is there any closing remark on this? This product suits for home and generally whatever comes to your minds.
So I would think that this is a product that is like an all-weather kind of a portfolio, right? So when I say all-weather, is that it is something that could, that could sort of be looked at across different market cycles, right? Whether Indian markets are doing well or no, whether the view changes or no, because you're investing across different asset classes, right? So therefore, it can be looked at as like a all-weather portfolio, not only in India, but you're also investing into we are also investing into international markets and, like we said, fixed income as well. So in a way, it provides like an all-weather kind of an option for investors. And secondly, I would just say that as an investor, obviously you would have certain goals that you want to achieve over the longer term, right? And for that, you would need a partner who can sort of build, like I said, something like an all-weather kind of a portfolio, which will help achieve those financial goals that you have in mind. So we think these strategies and the philosophy that Morningstar has, the team that Morningstar has, I think can be a good partner for investors in helping them achieve their financial goals over the longer term in that sense. So that's what I would say. Mr. Sivaram, if we can just add one more thing to that, I think some people were concerned that we haven't addressed their questions. So obviously, I'm sure we're going to get back to them.
But no, a lot of other questions were unanswered. Already we have overshooted the schedule by 10 minutes. Yeah. We will send across these questions to you, Mr. Dhaval. Definitely, participants, we will come back to you with a suitable answer from the AMC to you for all your questions. And it is wonderful. I would like to thank Mr. Dhaval for a wonderful presentation. And I would like to thank all the participants who participated. Definitely, it would have been an eye-opener for them, how important the asset allocation is to a portfolio. Thank you very much, Mr. Dhaval. Thank you very much for all the participants. God bless you.
Thank you, everyone.